Okay, so now we're going to move on and talk about bonds. So now that we have a good idea of what types of stocks are out there as far as growth stocks, blue chip stocks, and the penny stocks, now we're going to move into bonds. So a bond is a debt security or an obligation to pay back a debt that is issued. We've already kind of covered the difference between stocks and bonds in Module 1. The individuals who buy the bonds are collectively the lender for this line of credit. And then there are three types of bonds out there. We have corporate bonds, government bonds or treasury bonds, and then municipal bonds. So when companies issue bonds to expand operations, these are known as corporate bonds. Governments issue bonds to support government spending, and these are known as treasury bonds. And then municipalities issue bonds to support local government spending, and these are known as municipal bonds. And we're going to talk later about investments that are tax-free, and one of the best tax-free investments is municipal bonds. So when a company needs to raise capital, they have a couple of different options. The first logical option is to go to a bank and ask for a loan. However, when a company needs more than a bank can provide through a loan, they may issue bonds instead. And this allows numerous individual investors to lend the capital needed, and it does not put the burden on one single institution. So when a company needs more money than a bank can provide, this is often when they start to issue a corporate bond. Now, bonds can change hands on the secondary market after the bond is issued, and what I recommend looking at is the bond funds that trade through an ETF or an exchange-traded fund, which we're going to talk about in a little bit here. But I think that bonds are a very important part of any well-rounded portfolio. And as we said before, we were talking about how Benjamin Graham, his whole strategy is about having more money in bonds and less money in stocks during a bull market, and less money in bonds and more money in stocks during a bear market. So the bond issuer pays back the principal as well as the interest to the lender, and these payments are made on a predetermined schedule, and the rate is determined by the credit rating of the debt and the term of the loan. So longer term bonds are higher risk, and as a result they command a higher interest rate from the market. Now low credit quality bonds are known as junk bonds, and these are higher risk of default, and as a result they have a higher potential yield. So unfortunately, many people are attracted to junk bonds due to the high interest rates, but understand that these bonds are from borrowers with lower credit ratings, and as a result there is a higher risk of default, so you're getting into a high risk territory. So unlike stocks with a variable income, because the appreciation of your stock changes on a month-to-month basis, bonds are a fixed income investment. So a bond has a fixed interest rate that does not change, and the lender receives that amount by bond maturity. Now, most corporate bonds pay interest twice a year to bondholders. So unlike dividends that are quarterly, a corporate bond would pay you twice a year, not 4 times a year. So as discussed in Module 1, bonds are a form of debt while stocks are a form of equity. So remember that if you are a bondholder, you are not an owner of that company. You are simply somebody that is loaning them money, and they are going to pay you back plus some rate of interest based on their credit worthiness. And as we said, a well-diversified portfolio has a blend of stocks and bonds. So when it comes to bonds, they are broken down into 2 categories. We have investment-grade bonds, and then we have junk bonds. And as far as investing goes, the only bonds you want to put your hands on are investment-grade bonds. And in order to determine this, you need to look at the bond rating. So now we're going to talk about the rating of a bond. So a rating agency assigns a risk of default to municipal and corporate bonds. But as we said earlier, there's government bonds as well. Well, here's the thing. Treasury bonds are exempt from rating as these are considered to be of the highest quality and the lowest risk of default. So the highest quality bonds you can own are treasury bonds or government bonds, and then municipal and corporate bonds are assigned a rating. Now defaulting, so when we talked about the risk of default, now defaulting is a failure to fulfill an obligation, and at that point the debt becomes bad debt. So the 2 rating agencies that rate the creditworthiness of a borrower are Moody's and Standard & Poor's. Now I'm going to show you what that rating looks like. It's a little bit confusing at first, so I know you might be a little overwhelmed by this, but this is Moody's ratings, okay? I'm not going to read this to you, I just want you guys to understand what you're going to be looking for. And that red line there is the difference between investment-grade bonds and junk bonds. So if you're looking at bonds that have been rated by Moody's, you want to invest in bonds with a credit rating of Baa3 or higher. These are going to be considered investment-grade bonds, and the highest rated bond by Moody's is the AAA. Now here's what the Standard & Poor's rating looks like. It's slightly different, And again, that red line indicates the line between investment grade bonds and junk bonds. So if you're investing in investment grade bonds, which you should be, you would want to be investing in bonds with a rating of BBB- or higher, and the highest possible bond rating on the Standard & Poor's is again a AAA. So a AAA rating for both Standard & Poor's and Moody's is considered to be the highest quality and the lowest risk. But do remember that above that you have the Treasury bonds that are considered to be of the highest quality. So let's talk a little bit more about these investment grade bonds, because these are the bonds that I'm hoping are going to be part of your portfolio. This is a bond with a rating that corresponds with a relatively low risk of default, and investment grade bonds are the only bonds you should consider investing in. That's why they're called investment grade. They're worthy of investment. While riskier bonds command a higher interest rate that may seem attractive, these bonds are not investment quality. So before investing in a bond fund or a bond, I want you guys to analyze the credit rating of that bond or the fund itself. And you can do this very easily when you're looking at a bond fund. For example, if you go on the Vanguard website and look at some of their bond ETFs, you can click on them and it will give you a breakdown of the percentage of the bond that is what classification as far as the credit worthiness, as far as the credit rating. And whether or not it is done by Moody's or Standard & Poor's, you'll be able to tell by the sequence of the letters they are using, but you want to see bonds that are solely lying within the investment grade bond rating. So now we have junk bonds. Now junk bonds have a higher risk of default and a higher yield due to that risk. Now borrowers that do not have investment grade creditworthiness might be in good standing during a prosperous economy. So during a bull market, during a prosperous economy, a lot of the borrowers that fall under the category of junk bonds based on their creditworthiness, usually during a good economy they're going to be okay. But if economic conditions change, these borrowers are at a high risk of default. So some hold junk bonds in a bull market because they know that odds are they're going to be okay. But again, this comes down to the strategy of trying to time the market, which is really a losing strategy. It's impossible to do this with any sustainable accuracy. So, do I recommend doing this? Not necessarily. Long-term investors should avoid junk bonds as they should not be held long-term. The only bonds you want to hold long-term are the investment-grade bonds. And the best way to do this is through a broad exposure through an exchange-traded bond fund. And we're going to talk about bonds a lot in this course numerous times, but just to start off, a bond is a debt obligation, and bondholders receive interest in return for loaning the principal. A lot of people blur the lines between stocks and bonds, and we're really going to get into the difference of those two things because they are not the same thing at all. But what is important to remember is that because a bond is a debt obligation, bondholders take priority over shareholders during a bankruptcy filing. So if worst case scenario, you're invested in a company that goes bankrupt, understand that anybody who is a bondholder, they're going to get paid before the shareholders do because you're part of an owner of the company where they're just a debt obligation. So as a shareholder, you are last in line as far as the distribution of remaining assets goes. That's really nothing to be afraid of. I mean, if you're making sound investments, there's not a high risk of a company going bankrupt. I mean, if you're making high-risk investments, yeah, there's a higher risk of a company going bankrupt. So just keep that in the back of your mind, that shareholders are pretty much last in line as far as distribution goes when they go bankrupt and they're finally sorting things out. So let's go ahead and cover the difference between bonds versus stocks. So bondholders do not see returns generated from rising profits. Bondholders receive only a set interest rate, and that set interest rate typically does not change, so it's a predetermined figure. So many people like bonds because they have, in some cases, been a safer investment, but shareholders will see returns through the assets and appreciation as a result of rising profits. So if a corporation issues a bond and they use that money to, expand the business, and as a result, they're seeing rising profits, the bondholders are not going to see any of that. They're just going to get that predetermined interest rate. While the shareholders, because they are a part owner of the company, they're going to see part of those assets. They're going to see that asset appreciation, and they're going to be able to reap the benefits of those rising profits because they're part owner of that company. As a higher risk investment, stocks historically have paid a higher annualized return. So typically speaking, guys, stocks are a bit of a riskier investment. Again, like we said, as a stockholder, you're last in line to get paid during a bankruptcy filing. So bonds being lower risk, they have paid a lower annualized return. However, I recommend to most people for a long-term portfolio, you should have a blend of bonds and stocks because, it's best to be diversified, and there are certainly advantages to each one of these investment vehicles. So historically speaking, stocks have paid an annualized return ranging from 8 to 10%, and this is over the last 100 years. Now bonds, on the other hand, have paid an annualized return ranging from 5 to 7%, so slightly less on the bonds, but like I said, it's best to have a mix of both of those in your portfolio. Now with investing, the risk potential is relative to the reward potential, so when you have a higher risk associated with an investment, there is a higher potential return. But again, this is where some people get in trouble because they're looking for an unrealistic return from the market, and as a result, they take on too much risk or a risk that they're not comfortable with. And that's a big place people get in trouble. So you definitely want to make sure you have a realistic figure or a realistic approach when it comes to investing, and not be seeking an unrealistic return that's going to put you into a really high risk investment. Many successful investors have recommended a portfolio of blue chip stocks and investment grade bonds. Namely would be Benjamin Graham. He talks about this a lot in The Intelligent Investor. And that is because, the investment grade bonds have the lower risk potential, so you should have a mix of stocks and bonds. A well-rounded investment portfolio should include both stocks and bonds. And, the amount that you have in each really depends on your risk tolerance as well as the overall market conditions. And we're going to talk about that a little bit more going forward. So just an example of a portfolio. Actually, we're talking about it right now. So if you were in a market that was fairly valued, and we're going to talk about bull and bear markets in a little bit here, but basically if you're in a fair valued market where basically prices make sense and companies are fairly valued, it would make sense to have 50% of your money in stocks and 50% of your money in bonds. Now, if we're in a bull market, and that's when many stocks and many companies become overvalued, and this is straight out of The Intelligent Investor, guys. Benjamin Graham says, he recommends that you could go into 25% stocks and 75% bonds, because during a bear market, bonds tend to be more durable investments. And when stocks become overvalued, you'd want to have less of those in your portfolio and be more heavily invested in bonds. Now, the opposite is true during a bear market, because during a bear market, stocks become significantly undervalued. So at that point, it might make sense to have 75% of your money in stocks and 25% of your money in bonds. So this is called, reallocation, or, allocating a portfolio, or rebalancing. Basically, allocating more or less money into portfolio assets is known as rebalancing, and then stocks become overvalued in a bull market and should carry less weight in your portfolio. As we said, during a bull market, stocks become overvalued. They are trading at price levels that really don't make sense. And then in a bear market, stocks become undervalued and should carry more weight in your portfolio because you want to take advantage of the rally when, markets do correct. Many investors pay a fee to financial advisors, and one of the perks they offer is rebalancing. So rebalancing is very important. You can do it yourself, but a lot of people would rather have a financial advisor do this for them. But I'm guessing if you're somebody who is watching this course and you're involved on this level, you want to be in control of your own portfolio and you wouldn't mind rebalancing yourself.